Hello, everyone. Welcome to the Capital Intelligence channel. Today, we're bringing you an explainer that basically performs a full autopsy on a really persistent and honestly somewhat sobering issue: the underperformance of retail investors compared to the broader market. It's a fascinating topic because, despite having unprecedented access to information and zero-commission trading platforms right in our pockets, the everyday individual investor consistently lags behind institutional benchmarks. So we're going to break down exactly why this happens, digging into the structural, behavioral, and mechanical forces that are really at play here. We're kicking things off with a pretty shocking statistic from the 2024 Delbar study. In a period where the S&P 500 earned 25.02%, retail equity investors brought in just 16.54%. That is a massive 848 basis point lag, making it the second largest investor performance gap we've seen in the past decade. Even in a roaring bull market, individual traders are just leaving an incredible amount of wealth on the table. And guys, this isn't just a one-off statistical fluke. It's a systemic issue extending a 15-year losing streak where retail investors have simply failed to beat the market. So, here's our roadmap for this explainer. We're going to quickly cover the retail performance gap, dive into behavioral traps and emotions, the institutional advantage, social media and hype, hidden costs and taxes, and then wrap up with some actionable strategies for retail success.
Let's jump right into Section 1, the retail performance gap.
To really grasp the sheer magnitude of this problem, we need to look at the reality of long-term returns. Imagine a compounding mismatch where a $100,000 investment over 30 years leaves the average investor with 44% less money than if they had simply held the broader stock market index. An average equity fund investor ends up with just over $1 million, while just tracking the S&P 500 index would have yielded over $1.8 million. Retail investors aren't just missing out on a few minor percentage points here, they are literally cutting their potential lifetime wealth accumulation nearly in half by trying to time the market or pick the right active funds.
Moving on to Section 2, behavioral traps and emotions. Our autopsy leads us to the very first major cause of this gap: the human brain. We are hardwired with psychological biases that constantly chirp us up. You see, the market is driven by data, but human beings? Well, we're driven by emotion. It's a wild paradox. Studies actually show that the stocks retail investors choose to buy often underperform the exact ones they just sold. It completely flies in the face of rational market participation. What happens is, a trader gets lucky, they attribute it to skill, and boom, they become overconfident. That overconfidence leads directly to excessive, speculative trading and really perverse security selection. They end up buying high and selling low.
And this dynamic absolutely blows my mind because it perfectly captures the contrarian nature of investing. Historically speaking, when consumer sentiment is at its absolute lowest, the subsequent 12-month forward returns for the S&P 500 are actually at their highest. The lowest dips in consumer confidence, think the 2008 financial crisis or the spring of 2020, are almost immediately followed by massive spikes in market returns. But because of a psychological trait called loss aversion, retail investors tend to panic and sell at these exact bottoms, only to buy back in when it finally feels safe at the top, which is usually right before a correction.
All right, Section 3, the institutional advantage.
Let's shift gears from the human mind to the market machine itself, looking at the structural disadvantages retail traders face. Because let's be honest, emotional discipline is only half the battle when the playing field itself is fundamentally uneven. Retail traders are inherently playing a game of catch-up. While you're reacting to a headline that just popped up, institutional players are already miles ahead. They have dedicated research teams, early access to large-scale liquidity events, and incredibly sophisticated asset allocation models. By the time the news reaches retail, it's already priced in, and the institutions have packed up and moved on. Get this: 50 to 60% of market volume is dominated by high-frequency trading algorithms reacting in microseconds. That means retail is playing a professional's game, but entirely without professional systems. These algorithms absolutely thrive on volatility. They can execute incredibly complex trades before a human retail trader can even hit the refresh button on their browser. Trying to actively day trade against these institutional machines, it's literally like bringing a knife to a laser fight.
Which brings us to Section 4, social media and hype.
We've entered this era of massive information overload and the gamification of the stock market. We're seeing retail investors rely heavily on finfluencers to justify these viral meme stock trades. And here's the kicker: they usually enter the hype cycle last. Herd mentality, driven by serious FOMO, the fear of missing out, leads everyday investors to blindly buy into whatever is trending online.
But crowd conviction only feels like safety. Usually, it's the exact opposite. By the time a stock is going viral on social media, the smart money is already busy planning its exit strategy. Browser data reveals something pretty alarming. The median individual investor spends roughly 6 minutes researching a trade. 6 minutes! And during that brief window, they focus almost entirely on price charts and basic snapshot pages, while completely ignoring traditional risk statistics. They're mostly just looking at past price movements, trying to spot a fun trend, rather than looking at fundamental valuations, beta, or true volatility metrics. This lack of deep, disciplined research is a massive contributor to that 848 basis point performance gap we talked about earlier.
Next up, Section 5, Hidden Costs and Taxes.
So even if you miraculously manage to pick the right stocks, there are hidden friction drags like overtrading that can silently erode your wealth. High portfolio turnover triggers frequent capital gains. For investors in a high tax bracket, this tax drag can actually reduce the desired allocation to active mutual funds by as much as 50%. Every single time you buy and sell, you aren't just paying spreads, you are triggering taxable events. Over a few decades, this compounding tax drag negatively destroys a massive percentage of your potential returns. But hey, it's not all doom and gloom. There is a structural advantage retail actually can use, and that is tax loss harvesting. This specific strategy can increase after-tax expected returns by around 10 basis points per year for a U.S. large-cap equity allocation. By purposefully selling losing positions to offset the capital gains taxes on your winning positions, you can keep more of your own money working for you in the market. It's an incredibly powerful tool, but retail investors often overlook it because they are way too focused on chasing the next hot stock. Finally, Section 6, Strategies for Retail Success. Let's write the prescription here and figure out how to neutralize this behavioral gap based on everything we've just unpacked. To actually succeed, retail traders must stop competing on speed. You have to start adopting disciplined, rules-based, and tax-aware strategies. The data is crystal clear. Trade less and think longer term. Utilize dollar cost averaging to completely remove the emotional anxiety of trying to time the market. Incorporate things like tax loss harvesting and active ETFs to mitigate that silent tax drag. And most importantly, learn to separate the social media narrative from the actual fundamental numbers. So I want to leave you with a question today. As you look at your own portfolio, consider whether your decisions are driven by objective strategy or if you're unknowingly falling into the behavioral traps we've explored. Are your trades based on 6 minutes of chart gazing and a viral video, or are they rooted in a long-term, tax-efficient framework? Understanding these market mechanics is the absolute first step to closing your own performance gap. Thank you for joining us for this explainer, and we'll see you next time.